and welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from Pillar Two to recent U.S. regulatory developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar Two engine from PwC is a game changer for Pillar Two modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar Two tax experts from around the globe. PwC's Pillar Two engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in our Policy on Demand studio in Washington, D.C., where I'm excited to have Aaron Junge back on the podcast. Aaron is an international tax partner in PwC's Washington National Tax Services practice. Aaron also served as Tax Counsel to the U.S. House of Representatives during the passing of the Tax Cuts and Jobs Act back in 2017 and 18. Aaron, welcome back to the podcast.
Thanks, Doug. Really excited to be here.
So, Aaron, last week I was in your hometown of Omaha, Nebraska. I always think about you when I go back there, and for work, obviously. And one of the things on my bucket list, and fans of the Cross-Border Tax Talk know that I'm a big baseball fan, but in Omaha, they have the College Baseball World Series. And in the U.S., we take our university sports here very big. And I think you lived in Omaha most of your life. Have you been to the College Baseball World Series? And what's that experience like?
Yeah, so I actually have never been to the College World Series. I grew up in Omaha, spent over 20 years there. I can remember when the College World Series was actually held in Rosenblatt, which is in South Omaha by the zoo.
Okay.
And there's actually kind of a big brouhaha when they decided to move it up, build a new stadium in downtown. Right at the time, downtown wasn't as developed as it is now. But I've actually never been to a College World Series game. I'm sorry to report. So.
Okay. Well, maybe you and I need to go. Maybe that should be on your bucket list as well, and we can head there for a baseball game.
I think it's a great idea. We can do cross-border tax talks at the stadium.
Oh, now we're talking. I love it. All right. So let's get into the material here, and there is a lot of it, Aaron. So in September of 2024, the U.S. Treasury Department put out 600 pages of proposed regulations on the U.S. corporate alternative minimum tax. It's been a number of episodes since we've actually dedicated to the corporate alternative minimum tax here in the U.S. So let's start at a high level, particularly for some of our non-U.S. listeners. Aaron, what is the CAMT, as we'll refer to it?
Yeah, the CAMT is the corporate alternative minimum tax, corporate AMT. And as originally pitched, it was kind of a 15% book minimum tax. In fact, when it was going through Congress, that's what we called it, was the book minimum tax. And the idea is, at a big picture, a number of senators didn't like the idea that they'd pick up the Wall Street Journal and there'd be an article about, insert large company. Someone looked at their 10K and compared tax to net income and didn't end up with a rate closer to 21%, the U.S. federal statutory rate. And so the idea was we should make sure that large companies are paying a minimum of a 15% tax on their overall financial statement income. So we're going to start with the net income at the bottom of the 10K income statement, multiply that by 15%, and that's going to be the minimum tax liability. Now, of course, the guts of it are a lot more intricate than that, because as the Hill started putting this together, it was clear that you can't just take net income times 15% and call it a day. You need to take into account a number of other things. And so what you see in the statute is you start with your financial statement income, but you make a number of adjustments to it. Some of them make a lot of sense, right? Taking into account, flow-through entities, taking into account subsidiaries. Some of them are a little bit more niche, things for like qualified wireless spectrum or Alaska Native corporations. But you take into account all those and you get your adjusted financial statement income. You multiply that by 15%, and then you compare it to your regular tax, but you have to do a couple other things. And one thing you have to do is you have to take into account foreign taxes. And so there's a kind of CAMT-specific foreign tax credit that we can talk about. Mm-hmm. And then the other thing that you take into account is regular tax credits, right? Those come in kind of after the fact so that you don't get penalized for claiming R&D credit, LIHTC, something like that. And so you still get the benefit of those as well. And so that, the kind of general idea is that after you've done all that, you'll have ensured that those large corporations have paid that minimum level of tax, 15% of their kind of overall financial statement income, but taking into account those adjustments that were important to Congress.
Yeah, and so as we have these discussions, we'll talk about AFSI, which is this concept of adjusted financial statement income. And I think one of the many misconceptions, and there are a lot, we're going to try to unpack some of these here on the podcast, is that it's $1 billion of book profits, right? So not top line revenue. It is generally this adjusted profits for book purposes, and it needs to exceed $1 billion over this 3-year average. And then for inbounds, which we'll talk about, so foreign parented groups, similar standard, but then 100 million. So maybe talk a little bit about that, because I think that when these rules came out, many of us were focused very much on U.S. multinationals, but then we've also, obviously have to put a lens in for foreign parented groups.
Yeah, and so just to back up, so I was referring to the shorthand kind of big corporations or big companies. What the statute refers to as an applicable corporation. So to your point, to be kind of in scope of this provision, generally you need to have $1 billion of adjusted financial statement income on average over the 3-year period preceding the year that you care about. There are special adjustments you make in making that determination, and you're looking at the combined adjusted financial statement income of everyone within kind of a group of relatively related companies, what we call a Section 52 aggregation group. The idea was, look, if we're going to apply this tax to big companies, we should also be applying it to big foreign companies. And so there's a special rule that says if you have what's called a foreign parented multinational group, so you've got a multinational enterprise with a foreign corporation on top, you apply the $1 billion test, but you're going to do it a little bit differently. And you're going to do it to take into account not just your U.S. subsidiaries' income, but also the foreign subsidiaries' income. But there's also a second layer to it, which is we want to make sure that when we apply this to foreign multinationals, we don't do it with ones that have kind of a hot dog stand for a U.S. group. You got to have a meaningful U.S. group as well. And so there's a second step. If you have a foreign parented multinational group, you apply the general $1 billion test to everyone within that group, but then you also apply a second $100 million test. And that's really only looking at your U.S. corporations, their foreign subsidiaries, and then any foreign companies that are engaged in U.S. trade or business. So it's a more limited set of the overall group at a lower threshold. And that's really trying to make sure that you have enough U.S. connection to be subject to these rules, in addition to being a large enough enterprise to pass that $1 billion test and be in scope in the first place.
So many of us, when these rules came out, were focused on thinking about these large public companies, like the examples that you gave. But how does this sort of new definition, if you will, under the foreign parented multinational group potentially impact big fund structures, so even domestic or foreign investment funds? Like, who needs to be paying attention to this? We're going to talk about partnerships here in a second, but I think that, there was this misconception there's just big public companies need to focus on this. What do these new rules potentially mean for big investment funds?
Yeah, it's a great point, and it's kind of a thorny area. So, again, it's aimed at big companies. There's no requirement that you be publicly traded to be in scope. It's that $1 billion threshold is the test. The statute, the bill that Congress wrote, requires there to be a corporate entity on top to have a foreign parented multinational group. Again, the idea is the kind of publicly traded foreign company, although that's not necessary. But it authorizes regulations to also take into account non-corporate entities, which is a lot more common in the fund space. Sure. Right? Very common that you could have multiple companies, multiple portfolio companies, each of which could be quite small, right? They may not have $1 billion of average annual profits. They may have 100 million or 50 million or 10 million, right? Could be quite a bit smaller, but there could be several of them that are owned under the same kind of common equity structure, right? And at the top of that could be a partnership for U.S. tax purposes that ultimately flows up to the ultimate investors. It's a common structure that we see.
Sure.
And under the original version of the bill, those companies actually had the potential to be swept up in this because of the way that kind of Section 52 aggregation group I described works, right? They actually had the potential to be swept up. And there was an amendment made during the bill process, the so-called Thune Amendment. And there's actually some discussion on the Senate floor about this to ensure that those smaller groups should not get picked up. the proposed regulations expand the foreign parent and multinational groups in a way where those non-corporate entities, like that partnership on top, can actually be viewed as the parent of a foreign parent and multinational group. And it can cause that fund and all those portfolio companies to be treated as the same group and be tested as the same group for purposes of satisfying that $1 billion threshold. And so if in the aggregate they exceed the $1 billion threshold, then each of those could be in the soup, even though individually they may be much smaller than that. And so, I will say these are proposed regulations, right? This is Treasury's proposal about how to expand the statute to non-corporate parents of a potential foreign parent and multinational group. This is an area that seems to me ripe for comment. Mm-hmm. Would not surprise me if there are comments, because ultimately the impact could be much broader than what Congress originally had in mind. It could affect private equity funds. It could affect trading funds, sovereign wealth funds, right? All of those could have the potential to get swept up in this expanded scope of a foreign parent and multinational group that folks really weren't contemplating when they read the statute as it was going through Capitol Hill.
Yeah, and that's why I wanted to cover this at the top of the podcast here. I mean, a very important issue for people in that kind of financial services type space and the fund space. And, as we've talked about on many proposed reg podcasts where we've dealt with proposed regs, there is an opportunity for comments. And we are in that comment period, and we would highly recommend taxpayers, other stakeholders to provide comments. We'll cover that a little bit about the end. So we talk about domestic and foreign investment funds. What about partnerships? Because I think that's another big change. So how are potentially partnerships impacted by these rules?
Yeah, so potentially very significant for partnerships, Doug. If you think about just the kind of general rule, again, think about, pick a large multinational company, right? You can imagine within their structure, they could have both corporations and partnerships, and it may seem totally appropriate, right, that the partnerships get taken into account as well. The challenge is if a large company has a relatively small ownership interest in a partnership, maybe they own about 3% of a partnership, and the other 97% is owned by other investors out there. How do you take that into account? And there was a general principle under the statute, but it wasn't totally clear kind of how that applied. There was a lot of comments on a lot of different potential approaches. Should we just follow what's in the K-1? Should we just follow what's in our financial statements? Should we have a de minimis rule, do something else? We can talk about it more, but at a high level, these proposed regulations, when determining CAMT liability, when determining liability, whether you have a corporate alternative minimum tax liability, take kind of a bottom-up approach. So they have you start at the bottom of a stack of flow-through entities, right? Determine adjusted financial statement income down there, and then report it up through the chain, right? And what that means is potentially every partnership has a responsibility to compute this amount, right? Now, that depends on whether they ultimately are going to have a CAMT relevant partner. Mm-hmm. But think about, in a lot of cases, these structures may have tiers of partnerships, right? The actual operations may be operated, right, by one partnership, but there may be a stack of, many above it. And so they actually don't have visibility into who all the ultimate investors are. They're just reporting to the next tier up. And so if a request comes down the chain that I need this information to comply with CAMT, they now have to prepare that information and report it up, right? And when you think about kind of the originally intended scope that this CAMT was only supposed to apply to a couple hundred, right, large multinational companies, okay, that may or may not be true, right, as far as how many companies ultimately are looking at it. But there could be thousands, right, tens of thousands or even more partnerships that just have to engage in the compliance process to report it up the chain because of those small ownership interests that may be held by those ultimately large multinationals. And so it's a tough area. Again, another place where this is a proposal, and I would strongly encourage affected parties to be thinking about, does this make sense for you? And are there other ways of doing it? I strongly suspect folks over at Treasury and the IRS are very open to comments, right? They don't know every fact pattern that's out there in the real world, right? They know a lot, they see a lot, but they don't see everything. And so they really benefit from taxpayers coming in commenting about, this is the kind of fact pattern we're looking at and the kind of burdens it's creating, undue burdens the current proposals create.
Yeah, and as we think about those burdens, effectively, this CAMT requires a new set of books, and we'll unpack some of this. We're not going to get into a ton of the detail, but we've talked a lot about Pillar Two on this podcast and the separate set of books that is required for Pillar Two. Well, Aaron, as I travel around and the globe and meet with non-U.S. taxpayers and non-U.S. advisors, one of the most common questions I get about the CAMT, about this corporate alternative minimum tax, is that, is this the same or similar to the Pillar Two rules? What is I've got a very strong response to that, but what is your response to, are the CAMT rules the same or even similar to the Pillar Two rules?
No. I don't know if there's children listening, so I'll just say no.
Okay.
But no. Saying CAMT is like Pillar Two is kind of like saying an income tax is like a VAT with a subsidy for labor. Like it's not,
Ooh,
right?
like
it's
that.
just totally different. They both apply at 15% rate. They both take into account, right, financial statement income. But besides that, they are wildly different. They're wildly different in the scope of to whom they apply. They're wildly different in the base, right? They're different in how they address different jurisdictions. They're different in kind of policy, right, what they're trying to accomplish. I mean, there's just a plethora, to use a word, a plethora of differences, right, between them. And so I think it's really an impossible comparison between CAMT and Pillar Two. I would actually say that there's nothing alike.
Yeah. And other than which you can understand, like it's 15% and it starts with book income, but that is really where the differences end. So the other question that I get commonly, Aaron, is how easy would it be for Congress, for U.S. policymakers to convert the CAMT to a qualified domestic minimum top-up tax under the Pillar Two rules?
Yeah. So it would be real easy if they just repealed CAMT and enacted Pillar Two, right? Actually trying to convert it would be incredibly difficult, right? Because again, yes, they both say 15%, but 15% is really easy to write. Converting the base, converting the mechanisms, right, to be similar to one another is a very challenging task. And it's actually, it's something that we've looked at for groups before, trying to think about kind of what all changes would you need to make to get from CAMT to a QDMTT or an IAR, or both, because it actually has elements of both kind of slammed together. And it's really, it would be extraordinarily inefficient to try to make that conversion. The best thing Congress could do if it wanted to make that policy decision would be to simply repeal CAMT and then separately enact, Pillar Two or whatever version of that it wanted.
Yeah. And so we're a month away from the election. We're not going to turn this into an election podcast. We've covered some of those materials. We'll see what happens. But I think most of our guests that have come on, including myself, have are not overly optimistic about the U.S. enacting a Pillar Two rule, regardless of which administration ends up controlling the executive branch or Congress. But we'll continue to talk about that on the CBTT.
I don't think I've heard Pillar Two come up in a stump speech so far, but you never know.
Fair enough. Yeah, they're still a few weeks away from the election. We'll keep listening, Aaron. Yeah. All right. So now I want to dive in a little bit. I mean, there is so much in these regs, but really just kind of highlights, lowlights, depending on the perspective. But before we dive into some of the specifics, can you give a little bit of context? And you mentioned this earlier. Why is this reg package so big? I mean, 600 pages. And I think primarily Congress gave the regulators, Treasury, a lot of specific authority to be able to grant these regs. But talk a little bit about that, and then particularly in the context of the recent Supreme Court case, Loper-Bright, where now Treasury has this authority, but maybe somewhat more limited authority than before that case.
Yeah, so let me take that in two parts. So first, just kind of why do we need 600 some pages for actually a relatively short statute, right? If you look at the relevant statutory provisions, they're not that long. And the reason why is this is really an entirely new tax system that's kind of embedded in a couple provisions of the code, right? You mentioned before it's a new set of books, right? It is. It's not using your financial statements. It's not using your tax books. It's somewhere in between, right? And what you see in these regulations is trying to reconcile or coordinate, right, regular tax concepts with financial statement concepts in a way that's consistent with the congressional directives that we have. And in a lot of places, what that ends up looking a little bit like is somewhat of kind of a shadow Internal Revenue Code. And actually there was comments by IRS and Treasury officials over the last year or so describing just that point. How much of a kind of shadow code do we want, right, for this corporate AMT? And the moment you start replicating all the rules, or at least even some of the rules in the Internal Revenue Code through regulations, it takes a lot of time to describe that, and it takes a lot of time to actually put those in the regulation form. And so that's part of the reason you see so much here. You also mentioned a really interesting point, which is, well, how do we take into account Loper Bright?
Yeah.
Right? How do we take into account the Supreme Court's kind of revision of kind of how far administrative agencies can go, and does that impact the fact that we have this very expansive, right, 600-page package of regulations and preamble discussion? And I think, don't quote me on the number here, but I think it maybe 13 times, several times, right, that throughout the preamble, Treasury and the IRS specifically say, pursuant to the authority of XYZ, we're writing the following rule, right? They're very cognizant of
the congressional authority, of specific statutory authority.
Yes. Yeah. And that's linked into Loper Bright, right? Because the Supreme Court in that decision, on the one hand, it carves back the old kind of Chevron deference, right? The idea that if there's an ambiguity or a gap in the statute, that's an implicit delegation of authority. But it still preserves that Congress can make explicit delegations of authority. And Congress does repeatedly in this statute, right? There's multiple places, including a very broad reg grant at the end, authorizing Treasury and the IRS to write regulations. There is going to be a question, I think, about how far can courts take that carve out for express delegation, right? And I think it's untested. We'll have to see, right? The Supreme Court just doesn't provide enough guidance in Loper Bright. But at least for the time being, I think Treasury and the IRS are trying to work with what they've got, which is you've got a broad statute. It's got some principles, but there's a lot to fill in. There's an express grant of authority to fill in the gaps and address various issues, and they're trying to do that in the most efficient way they can, which unfortunately is 600 pages. Because there's just a lot to say.
It's a lot. All right, so let's get into a few of those things. We're obviously not going to be able to get into all the details. But let's start with some of the common adjustments to the adjusted financial statement income, or AFSI. Maybe just depreciation. Again, there's a lot there, but just sort of from a big picture perspective. Yeah.
So again, the starting point for CAMT is your financial statement income, right? So it's a net income or loss on the applicable financial statement. That's the starting point for adjusted financial statement income as well. There are certain express adjustments to that in the statute. One of them is for depreciation, right? One of them is generally that you apply tax depreciation instead of book depreciation with respect to tangible assets. What that means, though, is if you're going to be taking into account tax depreciation, you should also be taking into account the effect of tax depreciation, not just on income, but also on basis, because that'll impact if you later sell an asset, right? Whether you sell it at a gain or loss, if you later abandon an asset, or if you have an impairment with respect to an asset, right? How much of an item you have with respect to those. And so early on in the process, we got several notices, right, about future rules with respect to CAMT. And one of them had to do with depreciation. And it kind of forecasted a lot of what you see in the proposed regulations, which is generally you're going to be using those regular tax depreciation to adjust the basis in these assets for purposes of determining knock-on effects. And so you see that kind of implemented in these proposed regulations. I do think that once you start getting into the details of it, it's worth kind of rolling up your sleeves and going through with a fine-tooth comb, right? There's been a lot of questions out there about, okay, well, what about repairs? What about, certain kinds of expenditures? How do I take those into account? And there's some guidance in there that's worth, that helps you kind of think through those issues. But to me, those start becoming kind of more the devil's in the details, right? We got to figure out what it means for our fact pattern, and then how do these rules play out for that?
Yeah, exactly. And I think one of the things and which is why I wanted to start there, is that it effectively establishes this other set of books. Like, you're starting with the book income, and now you've got to layer in sort of this tax depreciation. And that is sort of the step one of this whole new set of books that we need for CAMT.
And you'll only do that and this is another part of kind of, the different set of books. You're only going to do that for certain assets, right? You don't necessarily do that for all of your intangibles, unless it happens to be kind of qualified wireless spectrum, or we'll talk about maybe a little bit later, purchase accounting in the M&A context, right? But so some assets you'll be using tax depreciation, some assets you'll be using book depreciation or amortization. And so you're going to have a new set of books, as you put it, where you're kind of combining different systems to produce an entirely different answer than what you have for any other purpose.
Right. All right, so let's move on to partnerships. We talked about some of the compliance burden associated with now, these large groups that have even a small investment in partnerships. But what are some more of the substantive issues as we think about calculating CAMT in the partnership context?
Yeah, so there's a lot in here. Unlike depreciation, where there was a lot forecasted in the notices, we had basically no guidance with respect to partnerships prior to the proposed regs. It's part of the reason that there's a later proposed applicability date for most of the partnership rules than there is for some of the other parts of the package. It's part of the reason that I mentioned I think there's going to be a lot of openness to comments from affected parties, and really encourage folks again to take up Treasury and the IRS on that offer. Generally, there's kind of a split in how you apply these rules based on whether you're determining whether you're an applicable corporation, or what I think of as kind of a scoping exercise, versus whether you're determining liability, right? So first you determine whether you're in scope, and for purposes of that, you're generally following your financial statement treatment of the partnership. Once you know you're an applicable corporation, that you're in scope of these rules, and you're determining whether you have corporate AMT liability, then you apply a very different approach. And it's typically going to be what I referred to earlier as kind of a bottoms-up approach. So you typically are going to determine the adjusted financial statement income of the bottommost partnership. You're going to ignore any financial statement income effects with respect to ownership of that partnership. And instead, you're going to take into account your distributive share of those partnership level determinations. And that distributive share is kind of interesting as well. This is one of the many kind of unanswered questions when the statute came out was, what does it mean to have a distributive share of adjusted financial statement income? Distributive share is that kind of tax term of art. Adjusted financial statement income is not a tax term of art, or at least outside of this provision. And so how do those two coordinate? And what the proposal would be is kind of a fixed percentage approach to determining your distributive share. Basically, what is your financial statement income with respect to your ownership in the partnership? Divide that by the adjusted financial statement income at the partnership level to determine a fixed percentage of the items of the adjusted financial statement income that you're going to roll up to take into account at the partner level. And so the regulations have a number of examples kind of applying this kind of 6-step approach as it's laid out in the regulations to different fact patterns to show how you roll up those items. One thing I'll just, remind folks, I don't actually need to remind folks because you'll notice that as soon as you get to your facts, is these rules are developed in the context of, or with a straw man of, Corporation X owns Partnership P. But in a lot of cases, it's Corporation X owns Partnership P, which owns Partnership Q, which owns Partnership R, S, T, And so there's going to be calculations that you got to roll up through the chain, and you got to think about kind of how that moves up. And it's not always going to line up with, subchapter K, distributive share, your general tax principles for allocating these items may not even line up with kind of the economic allocations, right? But it's based on this kind of formulaic approach that's at least being proposed in this package.
Yeah. So again, just another set of books. And particularly in these fund structures, which we talked about earlier, not uncommon to have tracking interest, special allocations, waterfall provisions, and now we have to do sort of a separate analysis for this quote unquote fixed percentage that is different, that could significantly different than the actual economics of the partnership or the tax treatment.
And for what it's worth, so there's a tough balance that needs to be struck here because the things you just described are really complicated.
Yeah.
And folks that deal with those every day for regular tax purposes know just how much complexity is involved. They have to work through that complexity to get to a regular tax answer. Then the question is, okay, now we've got this effectively new tax, right? This corporate AMT has a very different base than the regular tax does. How much of that complexity do we want embedded into this new system, right? And, arguments can be made about, well, if you take a formulaic approach, is that simpler? Does that kind of cut off some of the complexity, some of the teeth gnashing that goes into regular tax computations? On the other hand, any calculation that's different than what you're already doing, right? One is more complex. Just an
additional exercise.
And then also it raises the question of, well, there's a reason for that complexity for regular tax purposes, right? To kind of match tax liability with economics. And are we getting away from that, right? And is that is that an appropriate deviation?
All right. So let's move on from partnerships to international tax. And I know this is an area that you've spent a lot of time thinking about. This whole concept, and this was a big issue. We've talked about this on the podcast before, this concept of double counting. So how do the proposed regs sort of deal with this? And we had a prior notice that we've talked about, but talk a little bit about kind of how the holding of foreign stock has to do with the CAMT calculation.
Yeah, so I'll just note at the outset, Doug, this whole area kind of drives me nuts.
I know it does.
It's referred to as double counting, but I actually think it's a much broader issue than that. So the corporate AMT statute takes what I think is a very appropriate approach to stock in foreign corporations, but also domestic corporations that are not part of a U.S. tax consolidated group. And the approach is basically ignore what's on the financial statements, take into account what you do for regular tax purposes. And the reason for that is there's a very different treatment, right, of those interests for both financial accounting purposes and regular tax purposes. For financial accounting purposes, depending on the nature of the ownership interest, you could be doing it on a consolidated basis, on an equity method, on a mark-to-market method, right? There's different ways you could be accounting for your interest, and there's different ways you could take into account, for example, distributions, right, with respect to that stock. For regular tax purposes, you're generally going to have, with some exceptions, a realization approach to gain or loss on the stock itself. You're generally going to take into account the dividends with respect to that stock based on the tax earnings of that subsidiary, and you're frequently going to have dividends received deductions with respect to those dividends to mitigate multiple layers of corporate taxation,
Yes, yep.
right? Either in the U.S. or cross-border.
Fair enough.
Right? So, imagine you've got a U.S. company has investment in a foreign subsidiary. That foreign subsidiary has earnings that were taxed in a foreign jurisdiction. When it distributes those earnings, prior to 2017, or prior to 2018, the U.S. would typically allow a foreign tax credit, right, for any foreign taxes imposed on those earnings under old Section 902. Now we permit a dividends received deduction to mitigate that double taxation. If you didn't permit some kind of dividends received deduction for CAMT purposes, you would have double cross-border taxation, right? You would have U.S. tax on earnings that were already subject to foreign tax, which hasn't been within international tax norms for more than a century, since the League of Nations, right? And so I think it makes a lot of sense, the approach that the Congress took in crafting the statute. You see that in the regulations when a U.S. person owns stock of a foreign corporation. So dividends received with respect to that foreign corporation generally follow regular tax principles. You determine whether it's a dividend, return basis, capital gain, based on regular tax principles. You also determine whether you get a dividends received deduction under any of the number of DRDs in the code based on regular tax principles when the U.S. holds it. That also mitigates a separate double counting concern, which is those earnings of that foreign subsidiary, they may have also already been subject to CAMT, right? Because the statute requires the U.S. shareholder to pick up their pro rata share of the adjusted net income or loss of a CFC. And so if the foreign subsidiary is the CFC, those earnings are already picked up for CAMT purposes. Making sure they don't get picked up a second time on the dividend is also mitigated by taking into account those regular tax considerations. But where things fall off the rails, in my opinion, is when we get to foreign stock of a foreign corporation held by a CFC. There's no indication in the statute this should be any different than stock held directly by a U.S. person, but the proposed regulations do treat it differently. And there's some cases where this is still addressed favorably. So if you have a distribution from one CFC to another CFC, you would be concerned, right, that the earnings that are being distributed have already been subject to CAMT once. They'll need to be subject to CAMT again. And generally what these rules provide is, hey, if you would qualify for an exclusion for regular tax purposes under 959 or 954C6 because it's a distribution of previously taxed earnings, or it's a distribution to which you can look through for regular tax purposes between CFCs, then you can exclude that dividend for CAMT purposes as well. And so in that way, you don't have double counting. But if you don't qualify for one of those exceptions, you don't get that benefit. So, for example, imagine that a U.S. company holds a non-controlling interest in a foreign subsidiary. They own more than 10 but less than 50% in a foreign corporation. If they hold it directly, for regular tax purposes, any distributions from that subsidiary are exempt from U.S. tax because they were already subject to foreign tax. The same is true for CAMT purposes. You carve out that dividend. But if it's held through a CFC, these regulations would tax that from a CAMT perspective. They would pick it up, and they'd provide no mitigation for the taxation already imposed by the foreign jurisdiction. And so they actually deviate from 100 years of policy in this country of mitigating double taxation with respect to those ownership interests. And so we can get even more granular. I'm gonna spare you from that, but on kind of how these differences manifest, what I will say though is when you have a taxpayer that owns foreign corporation stock directly versus through a CFC, you can get very different results. And it's important to kind of dig into that for your fact pattern and then be thinking about kind of where is it appropriate to comment for Treasury and the IRS to be thinking about maybe we should be taking a different approach when the regs go final.
Another area ripe for comments. All right, so the last topic I want to cover is M&A.
Okay.
And maybe just sort of the highlights or lowlights, depending on the perspective, for companies that are in scope of these rules and engaging in M&A activities.
Yeah, so maybe just a couple points here. So one, there are some really important rules, many of which were forecasted in prior notices about quote unquote covered non-recognition transactions and covered recognition transactions. So think about in the M&A context, if you have a reorganization, a merger, a spinoff, something like that.
That would normally be tax-free for U.S. purposes.
Oftentimes it'll be tax-free for regular tax purposes. Sometimes you will have some taxable income because of what we call boot, right? You might receive some non-stock consideration as part of the transaction. These rules try to take that into account, right? And they generally try to take it into account by preserving the non-recognition treatment of non-recognition transactions, preserving the recognition treatment where there is for regular tax purposes, but doing it using our extra set of books, right? Using CAMT basis, right, rather than regular tax basis. And so you're going to see a lot of thematic similarities between these proposed rules and the regular tax rules, but the calculation is going to be different because you're using that different base. But another area that I think is worth focusing on is really in the recognition transaction space. It could come up in non-recognition transactions as well, but financial accounting has this concept of purchase accounting.
Right.
Right. If you acquire a target, in many circumstances, you will effectively, and I'm going to reveal my ignorance of financial accounting now, but I believe in effect, you push down that purchase price and take it into account in determining the book basis of the inside assets. That is conceptually similar to a 338 election that you can make for regular tax purposes that sometimes is made, sometimes is not. What the proposed rules would do is generally take into account purchase accounting unless it's a foreign target, and then it generally would not. And generally would not take into account 338 elections unless it's a foreign target, in which case we do take into account 338 elections. And so there again, it's just worth keeping track of, what is the financial statement treatment of that acquisition? What is the regular tax treatment of that acquisition? And then we should consult the proposed regulations to figure out what is our third treatment, the CAMT treatment, which could vary depending on nature of the transaction, the nature of the target, and so forth.
And I would be remiss if I didn't mention the fourth set of books that taxpayers are going to need to think about, which is Pillar Two.
Yes.
Right, on very similar type of M&A transactions. So a lot of compliance and challenges for taxpayers. So maybe, Aaron, as the last question here, what should taxpayers do in the short term? I mean, we've got these regs right in the middle of the 2023 filing season for corporations. Obviously, you mentioned providing comments. I think there's mid-December 2024. Taxpayers have the opportunity to provide comments, but any other big picture lessons or thoughts for stakeholders in this area?
Well, I think it's primarily that, Doug. So because these came during the filing season for extended due dates for calendar year taxpayers, most taxpayers haven't focused on the rules for 23. The proposed regulations generally don't apply to calendar year 23. They generally apply to calendar year 24, 25, depending on the rules that you're looking at. And so a lot of folks haven't had the opportunity to apply these proposed regulations to their facts yet. And that's where you're really going to see issues bubble up.
Sure.
Right. And so I would strongly encourage folks to start applying these proposed rules to their facts, see where the issues bubble up, so you can make those comments to Treasury and the IRS and say, hey, here's an area where it doesn't make a lot of sense, right? Or here's an area where there's a lot of compliance burden, or we actually can't figure it out because we don't have that information available, and here's a better way of doing it. I would recommend folks start doing that now. We've only got a few more weeks, but only a few more weeks to get those comments in. And then after that, it's going to be about kind of building systems to track this third set of books, because ultimately that's what's going to be necessary to comply with the rules, comply with the proposed rules, if they go final beginning in 24, 25, whenever they're applicable.
Yeah, and maybe the other thing that I would recommend is for those taxpayers that maybe did the initial calculations and determined that they were out of scope, now sort of layering in these new rules, particularly with partnerships, just to make sure that, and for the fund structures to figure out whether they're in scope or out of scope, and then they have to go down the journey of the whole separate set of books and going through those calculations. So, Aaron, a highly complex area. Thanks for coming in. You always do a great job sort of breaking that down, and we're going to continue to see developments in this area. So final regulations will be out at some point. Hopefully the taxpayers and stakeholders' comments are incorporated into that. And when we get those, we'll bring you back and talk more about it on the Cross-Border Tax Talks podcast. So thanks for coming on.
Awesome. Thanks for having me, Doug.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Aaron Junge, International Tax Partner in PwC's Washington National Tax Services practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.